Good morning. Thank you all for joining our education class today. And my name is Julia Jiang, and from Kowa Bank Dynasty. I have the great honor to serve as your 2025 Education Committee member. A few housekeeping tips before the class starts. So please silence your cell phone, and if you need to answer your phone, please walk to the hallways. At this time, I'd like to introduce our special speaker today, Stephanie Kelsey. And this is Stephanie Kelsey. I have a brief introduction. Stephanie Kelsey is a Southern California Division Manager at Asset Preservation, specializing in IRC 1031 tax-deferred exchanges. She has over a decade of experience in both residential and commercial real estate, having specializing in having both residential and commercial real estate, having facilitated hundreds of 1031 exchange transactions. Stephanie provides expert education and guidance to investors, attorneys, and real estate professionals. She is known for the thorough understanding of client needs, exceptional service, and up-to-date knowledge of tax exchange regulations. Founded in 1990, Asset Preservation Inc. has successfully completed over 200,000 exchanges and is recognized a national leader in 1031 exchange service. Now, help me give a very warm welcome to Stephanie.
Everybody, thank you so much for having me here today. Is this working? Can you hear this? Okay. Like she said, my name is Stephanie Kelsey. I'm with Asset Preservation. I'm the Southern California Division Manager. We are a qualified intermediary as well as a 1031 exchange accommodator and educator. So not only do we do the exchanges, we also make sure that everybody understands how they can use those to their advantage and work with their clients and their title people to actually get more listings as well. So here we go. I think I'm holding this the right way. So as a disclaimer, again, I'm a qualified intermediary. We are a non-regulated industry. I'm also not a CPA, nor am I a tax advisor. I'm simply here to explain the rules of 1031 exchange, make sure you understand how to use them, and how you can help your clients benefit from deferring their taxes. So as she mentioned, Asset Preservation, we are a leading national qualified intermediary. So I'm the division manager for Southern California, but I actually have clients all over the country. I work with other large businesses that have clients everywhere. So we are national. We are one of the largest qualified intermediaries in the United States. Again, we were established over 35 years ago. We are a member in good standing with the Federation of Exchange Accommodators. Again, this is very important. We are a non-regulated industry. So it's important that when your clients are working with a qualified intermediary, that they have someone who's trustworthy, has a long-standing record, because there have been bad actors in the past who have invested funds and then they're not there at the other end, or have actually absconded with your client's funds. So it is very important when they're picking a qualified intermediary that they have a company that is strong. We're also backed by stewards in information systems, which adds an extra layer of protection for your clients' funds when we're holding them. So what we're going to be covering today is, again, 1031 exchanges, tax deferral on the sale of a property used in trade or business or held for investment when exchanged for like-kind replacement property. We're going to go over capital gains taxes, exchange entities and why those are so important, like-kind property, Delaware statutory trusts, vacation homes, holding period, delayed and reverse exchanges, and identification rules. So when your clients have property, obviously they have three options. They can hold the property and see how the market's going to go. They can decide to sell that property and then pay all those capital gains taxes and reinvest in something else. Or they can do a 1031 exchange where they have the potential to defer all capital gains taxes with a full 1031 exchange, or they can do a partial exchange and receive some boot, which would be subject to capital gains taxes. So what are some reasons that clients are going to want to do a 1031 exchange, or what are some reasons that investors might want to sell their property? Leveraging is one. Maybe they've had something for a long time that's low to no debt on it. So it's a good time to sell that property and either move into a larger property or buy multiple properties. Diversification of asset or geography. Maybe they've only been in multifamily, maybe they've only been in retail, and they want to kind of change the asset that they're holding. Or maybe geography, they want to move it to a more growth heavy area so that they're going to actually get more appreciation from their property. Consolidation, maybe they're managing too many properties and they want to go into something smaller that's easier to manage, or maybe they just want to go into an apartment building and get a management company to cover that. Cash flow, obviously that's the main reason that people are investing in real estate, is because they want that return on their investment. Management relief, again, it can be done by consolidating or possibly going into a passive investment vehicle, which is something like a Delaware statutory trust, which I'll touch on later. Estate planning, also another thing, say you've got one asset and you've got 3 kids that you want to leave your properties to and you don't want them fighting. Maybe you're going to diversify into multiple properties, or again, possibly go into something like a Delaware statutory trust. So some of the other tax codes that apply to real estate, there's tax code 1031, again, tax deferral of the sale of property when exchanged for like kind. Section 1033. Now, this is important if you're going to be working with any investors who suffered from the fires, because this is something that they need to, when they receive insurance money, the state sees, or the government sees that as a gain. So if they do not file a 1033 and they have capital gains from the insurance payout, they could have to pay capital gains on that, capital gains taxes. So if you have any investors who suffered from the fire, it's important that they understand that they need to file for a 1033. Otherwise, they'll be paying capital gains on anything that was given to them through the insurance company. If anybody needs more information about that, they can call me directly and I'll talk to them about the whole process. But it is important, if you've got investors who suffered from the fires, that they, and actually even anybody who suffered from the fires, if it's their primary residence or their investment, if they do not file a 1033 and the insurance money gives them gains, they will be subject to capital gains taxes. So they need to do that. Tax code 121. That's for primary residences with the 250,000 to the 500,000, depending on if you're married or single, tax exclusion. 453 is for seller financing, where you get an installment treatment of the sale. And tax code 721, which is something where if you were in a Delaware statutory trust, you can go from a 1033 to a Delaware statutory trust and then 721 into a REIT. So those are some of the tax codes that apply to real estate that are important for you guys to know about. Okay, so as I said a minute ago, I'm just going to touch on the 1031 and 1033 because it's so important for so many of us who have clients who are affected by the fires. So 1031 is a voluntary exchange. Okay, you have to use you have to use a qualified intermediary. There's strict guidelines of 45 days to 180 days for identification and replacement. And then the investment must be for like-kind property. For a 1033, they do not need a qualified intermediary. They can get the funds directly. The funds go directly to the client. There is no form for a 1033, so they have to make sure that their accountant or they themselves file an addendum to their taxes. They're going to have 2 to 4 years to reinvest those funds. Anything that's not reinvested within the 2 to 4 years will be subject to capital gains tax. The timelines, like I said, 2 to 4 years. Primary residences are eligible for this tax deferral strategy as well. And the replacement property needs to be similar or related in service or use. So if it was an apartment building, they should do something else that's going to be rented out as a residence for someone. If it was their primary residence, then they want to replace it with another primary residence. So 1031 exchanges have been around for quite a while, since 1921. One aspect of the tax code provides taxpayers who own investment real estate a significant tax advantage for more commonly deferred. I'm so sorry. So 1031 allows taxpayers who are holding real estate for business purposes or for investment purposes to defer all of those taxes that would otherwise be taxable if they were just to do a sale. So what are the capital gains? This is what your clients are trying to avoid when they do a 1031 exchange. So first off, we've got taxation on depreciation recapture of 25%. Federal or state are 15 to 20%, 3.8% for net investment income tax, and our state tax for California is up to 14.4%. So what is that going to look like for a couple who's filing jointly? They're going to have a property, they're going to sell it for $1 million. They purchased the property for $400,000. It's been fully depreciated over 27 and a half years for residents or for Yeah, for residents or 39 years for commercial property. So now their new,
Nope, sorry.
that's okay, their new tax basis would be $100,000. That's been adjusted because of depreciation. So now they're gonna have 900,000 in capital gains. And all of those 4 tiers that I mentioned earlier are going to apply. So what is that gonna look like? So we just discussed this, they're gonna have 900,000 in capital gains. So what is that gonna look like? So this is what it would look like if they were to do just a regular sale. So they've got that $1 million. This is after closing costs and commissions that do not need to be reinvested. So 300,000 was the depreciation. That's gonna be taxed at 25%, which is $75,000. The remainder of that is $600,000, which is taxed at 20%. The 900,000 for net investment income is 3.8%. And we're gonna say the state tax, they tax them at 13.3%. So you see, if they did a regular sale instead of a 1031, all they'd have left over at the end would be $651,000 to reinvest. So again, this is why, one of the reasons that the 1031 is so important. So you can see the difference here. If they do the 1031, they're gonna have that full amount to reinvest. So if they were to get a loan with an LTV of 75%, the most they would be able to reinvest if they did a direct sale would be $2.6 million. If they do the 1031 exchange and do a full tax deferral, they have the potential to reinvest $4 million. That's a huge difference for your clients when they're going to be doing an investment. This is how they're going to grow their investment portfolios and increase their return on investment. What is the tax code? No gain or loss shall be recognized on the exchange of real property held for productive use in a trade, business, or for investment purposes, if such property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade, business, or for investment purposes. What is not allowable for a 1031 exchange? Primary residence or a second home. Those are not allowable. Stocks in trade, stocks, bonds, or notes, other securities of evidence or indebtedness, or interests in a partnership. Now, if your clients are in a partnership, the partnership as a whole can do the exchange, but the partners cannot just decide to go their separate ways. If it's a tenants in common, they're fine. They each own an undivided interest in the property. They can take their percentage and go their own ways. But if it's a partnership, then the partnership has to do the 1031 exchange. The only way out of that is to drop out of the partnership, which they need to get an attorney or a very good tax advisor to help them do that. It's called a drop and swap. The further away from the sale, the better for that. California is very strict with drop and swaps. So if your clients are interested in doing that, please have them do it well before they're going to even list the property. So exchange entities and why these are so important. What we want to remember about 1031 exchanges is it's a tax code and it applies to the taxpayer. So we always want to make sure that when we're working with clients that the actual taxpayer is identified. Like I mentioned earlier, if it's a partnership, the partnership is doing the exchange. If it's a wife selling her property, the wife is acquiring the property. If it's an LLC where they're receiving a K1, then the LLC is going to do an exchange. Sometimes people have an LLC and it's strictly for liability purposes and they are actually the taxpayer. We need to make sure that they're identified correctly, because if they identify the LLC and the LLC is not the taxpayer, that could blow the exchange down the road. So we want to make sure that they understand who the actual taxpayer is. Partnerships, as we said, if the partnership is doing it, then the partnership is acquiring. Just because something's on title doesn't necessarily mean that that's the answer to who the taxpayer is, because people don't always update their title. You know, spouse could pass and 2 names will be on there, or they could remarry and they haven't added, but they've been filing jointly. Sometimes they put a kid on there, their son or daughter, and the son or daughter have never paid taxes on the property. They're not doing the exchange. Only the taxpayer is doing the exchange. So it's important because people do not always set up their title correctly. Like kind property. This one is one that's always misunderstood. So all these properties that are on here right now are like kind property, and you can go from any of these. So any real property held for productive use in a trade, business, or for investment. You can go from raw land to multifamily, to retail, to industrial. They're all allowable. So again, what property is excluded? Principal residences or properties that are held for flips. If your client buys a property, fixes it up and sells it, that does not qualify for a 1031 exchange. that is considered inventory. The main thing with a 1031 exchange is it needs to be held for long-term investment purposes. So if they fix it up, rent it out for a couple years and then sell it, fine. But if they're going to fix it up and sell it immediately, it would not qualify for a 1031 exchange. Vacation homes. Lots of people think that vacation homes are not allowable for 1031 exchanges, but they are. There are very strict guidelines. Has to be held as a vacation rental for 2 years. Must be rented out minimum of 2 weeks per year and cannot be used more than 2 weeks or 10% of the amount of time that it was rented out. And people go, oh, well, how are they going to know? If you're getting audited, the government really just digs in to find out, well, you said you weren't there, but we've got you buying gas here and at this restaurant and this and that and whatever. Like, where were you staying during that time? So you want to, vacation rentals are allowable, very strict guidelines. It is important to follow the guidelines, because otherwise there's possible of disallowing the exchange. They're going to have to pay those capital gains, up to a 50% penalty, and sometimes jail time. So always tell your clients when they're doing something like this, make sure that they stay within the rules. We don't get many gifts from the IRS, but a 1031 exchange is a gift. Additional ownership. This is a Delaware statutory trust. These are also referred to as a DST. This is a passive investment vehicle. Now, you as realtors cannot benefit on the buy side, but if you have clients that own multiple properties, they are just tired of owning things, they don't want to manage anything anymore, and they don't want to pay taxes, this is a good alternative for them. You're not going to get anything on the buy side, but you might get more listings from this. And your client will definitely tell their friends if they're sitting back and making money by doing nothing, and their friends are still huffing around, fixing up toilets and things like that, they'll say, hey, you should do this. Lots of times it increases what their return is on their investment. So what is a Delaware statutory trust? So they are allowed to 1031 into a DST. What happens is there's a sponsor entity. The sponsor entity is going to create a portfolio. It can be made up of 1, 2, 3, 4, 20 properties. Might be multifamily, senior housing. It could be student housing. It could be investment grade retail net lease properties. It could be any type, could be like 3 FedEx warehouses and Amazon warehouse. So what happens is your client can take their money from their sale, use tax code 1031, buy into a portfolio, and they become a fractional owner of all the properties in the portfolio. So a couple good things about this. Passive, they sit back, the money comes to their bank account every month. Great for estate planning. If they have multiple heirs and they're like, they're going to fight over the stuff we have, they're going to sell it, they don't want to manage it, they can be divided up by any percentage they want to leave to their heirs. If they're worried that their heirs are going to go blow the money when they get it, they have a holding time. So for a Delaware statutory trust, when you buy into it, you're going to be stuck in it for either 3 to 5 years or 5 to 7 years typically. So if your heirs inherit this property and there's 3 years left on it, then they're going to get used to that mailbox money that's coming every month. So when they finally do get to cash out of that, they're going to be less likely to blow that money, because they're going to be like, this makes my house payment, or it's putting my daughter through college, those types of things. So Delaware statutory trusts are very convenient for older investors usually, who are thinking, I don't want to manage property anymore. I don't want to pay the taxes. And how am I going to leave this to my heirs? Does anybody have any questions about Delaware statutory trusts?
About heirs, so when they finally get this DST, are they
Mhm.
gonna pay the estate taxes or just income tax?
They're going to get a step up in basis, so they won't be paying capital gains taxes, but they would be paying regular taxes. Yes.
If they wanna then, let's say they inherit the property and now says, hey, you know what, I wanna sell it now. Or do a 1031 exchange, will they get the full price, or now it's not because they're another?
So they're going to get the step up in basis when they inherit the property. So if it's appreciated by the time that they're able to sell out of it. So what happens with a DST is, again, they close them up every 3 to 5 years or 5 to 7 years, depending on how it's set up. And then there's an exit strategy for that Delaware statutory trust. Different DSTs have different exit strategies. One of the exit strategies is they can use tax code 721 to go into a REIT. If they've inherited it and they only have it for like 2 years, there might not be enough appreciation to really care about the capital gains taxes. So they won't have to possibly do a 1031 exchange. But if you're the owner of it and you still have those capital gains, you can 721 into a REIT. You can do another DST. You can go back to owning your own property or cash out and pay capital gains taxes. So, yes.
Definitely, you hit the point. So let's say the heirs, let's say, I'm very, yes, myself. Let's say when my kids say, I don't get the appreciation from a DST because when they be sold, whatever the amount is distributed among all the investors. So as they take the money out, and they take the money out and buy another, let's say 40 or 100 unit apartment. What happened? Can I put 1031 out of DST back into the apartment?
So it's for the heir, yes.
Yeah, but yeah.
You as yourself,
They do whatever they want to do.
the heirs can, if they don't have a lot of appreciation, they don't need to do a 1031. They can just take the money and go into whatever they want. If there is a good amount of appreciation and they want to defer those capital gains taxes, they can still 1031 back into real property, into another DST, or 721 into a REIT.
Because sometimes you gain more by owning your apartment than the shared DSC liability. The amount of appreciation is not as much as if you control the whole appreciation of yourself.
That can be true. It depends on the DST that you go into. So for a Delaware statutory trust, you do need a securities advisor, a securities representative to help with that because it is a security. So you need a registered representative to talk to you about those DSTs. If you have any clients who are interested in them, I have a couple advisors that I have vetted myself. Basically, they have strong due diligence teams, and they do a deep dive into the private placement memorandum, which is like a brochure for that Delaware statutory trust. And they are going to look at all the properties in it, and they're going to do a deep dive on each one, looking at occupancy, crime rate, income, population, etc., to see if the sponsor who put it giving accurate estimates of performance. So the ones that I work with, they're not an affiliation. They basically, their due diligence teams look at all the DSTs on the market, and they usually only recommend about 10 to 15% of them. So it's important that they're working with someone who's going to do a good job on the due diligence of looking at the DST. But it is a really great opportunity for you guys if you've got older investors who are thinking about estate planning and are tired of management, especially if they own multiple properties. You can get multiple listings for them. Split treatment. Say you've got a fourplex, you live in one of them, and the other 3 are rented out. Can you do a 1031? Yep, you absolutely can do a 1031 on 75% of that property, and then you can use tax code 121 to go ahead and purchase another property. So it's important to understand, some people think, oh, well, I live in it, so I'm not able to do the 1031, but it can be divided up by percentage that's investment and the percentage that is residential. So can I convert my residence into a rental? So for people who've owned a properties for 10, 15, 20 years, that 121 tax code that's going to give them $250,000 to $500,000 is not going to cover anywhere near the capital gains that they've acquired over the years, but they don't want to pay the capital gains taxes. They can convert that residence into a rental place, so they can then use the tax code 121, take that amount out, purchase something else, and then turn it into a rental. So the way it works is now it's a rental property. They can 1031 that. And then if they wish to sell it later, as long as they've lived in it for 2 of the past 5 years, they can use that tax code 121 and sell it. And then they can 1031 the remaining amount and use the 500,000 to purchase another rental. So they'll take their property, turn it into a rental. They'll rent somewhere for a couple of years. Then they can sell it and then defer those capital gains taxes. So split treatment here. They've got $1 million residence with several rooms, and they're going to Airbnb a portion of it. So they can 1031 on the amount that they were using as Airbnb, and then they can use the rest of it for tax code 121. So there are ways, if they use it, portion of it as their own primary residence and a portion of it as rental, they can absolutely use both tax codes. Again, here's another example. I didn't realize that I had this many in this one, sorry. So $750,000 residence with 3 floors, a third of the home is office basement, so $250,000. They're using that amount as trade, business, or investment purposes. They're using that as their business part and they're putting it as their business on their taxes. They're separating a portion of the house out that they're using strictly for office purposes. Again, they can use both tax codes. So holding period, how long do we need to hold the property? Technically, there is no holding period. Conservatively speaking, there is a private letter ruling by the IRS indicating that if you hold the property for a minimum of 24 months, that satisfies the government's criteria for long-term investment purposes. Because again, when you're doing investment property and wanting to do a 1031 exchange, the main thing is what is the taxpayer's intent when they purchase the property? Yeah.
I'm just going back onto the previous one with the split
Mhm.
you mentioned. Suppose like somebody passed away and there's two people, there was a living trust and the two sisters inherit that property. Now they're gonna lease it, and then, but eventually if they wanna do a 1031 exchange, would it be a good idea to change that into a tenant's income? Say that one sister says, no, I don't wanna do a 1031 exchange, and the house is worth $1 million. But the other sister says, I would like my portion of it to go into a 1031 exchange. Could that happen?
As long as it's a tenants in common situation, they can do that.
Okay, tenants in common.
Mhm.
Okay, and
Yeah,
then,
so they each own their undivided interest in the property. So one sister owns 50%, the other owns 50%.
okay. So that's the answer for the split if they want to do it that way. Thank you.
Yeah. Mhm. Okay, so sorry. So what the IRS, if you're getting audited, what they're going to be wanting to know is what was your intent when you purchased the property? So again, private letter ruling, 2 years will satisfy. If they need to do less, you want to have at least one tax year because you have to be a taxpayer for the property. Okay, I had a client purchased a property for $350,000. He had a paper trail showing what his intent was. He was working with realtors. He purchased land. He was going to build on it and build a bunch of little bungalows that he was going to rent out. So he had zoning people, he had architects, he had construction people he was engaged with. 8 months later, someone came and offered him $850,000 for the property. It wasn't on the market. He had a long paper trail showing what his intent was when he purchased the property. So he and his CPA decided that there was enough of a paper trail where if he were to be audited, even though it was way less than 2 years, they could prove what his intent was when he purchased the property. So that's something that's important. If your clients have an intent to move into the property later and they don't know how long, you want to make sure that there's some type of paper trail indicating what their intent was when they purchased the property. Yes.
So if the property is on joint tenancy, then we cannot do the 1031, or both of them have to do it.
If it was leased out, they could do the 1031. Because they both probably would have been paying. If it was leased out and they were both reporting it on their taxes correctly, and they were both separated with the burdens and benefits of the property, what the tax auditor is going to be looking at is, what are the burdens and benefits? Are you each paying your own share of insurance? Are you each getting a certain amount of the rent? How was this divided out? So yeah, even as joint tenants, as long as it's not a partnership or some type of LLC that was created, and they both have a certain percentage of ownership to the property, and it's not technically on title as TIC, but it's basically a TIC in every other aspect, then they would be allowed to do a 1031 exchange. Okay, so no cheaters. Again, 1031 exchange, it's a gift. We don't get many gifts from the IRS. It's important that we don't play around or try to cheat because there could be penalties where you have to pay the capital gains taxes. You have a 50% penalty on that, and there could be some jail time. Here's an example. A California realtor did an exchange of her relinquished rental property, but acquired a residence as the replacement and used it as her principal residence. She obtained an owner-occupied loan on the replacement. She falsely reported the primary as a rental property and falsely reported rental income to cover her tracks. She also listed another rental as her residence address on her tax returns. She pled guilty to tax evasion, did 14 months in prison. So we always want to make sure that your clients are using the tax code correctly, because otherwise it will have consequences. We're like, oh, how are they going to know? They dig. They dig. They will find out. And if they find out that you're cheating, it's not a good thing to happen. I've had people say, well, this, and I'm like, no, 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 please don't do that. Okay, so the exchange equation. So this is for full tax deferral. You've got your relinquished property, your property that you're selling, you're gonna sell it for $900,000. There is debt on that property of $300,000. The cost of the sale is $60,000. That's closing costs and commissions. That amount does not need to be reinvested. So at the end of that sale, they're gonna have $540,000 left over. They are going to purchase a replacement property for 1.2. So the main things when you're doing a 1031 exchange is you need to reinvest all the net proceeds, and you need to acquire a property with greater or equal debt. So you need to replace that debt with either new debt or with cash. So debt that's not replaced is referred to as mortgage boot, and the other is cash boot. So here, again, they're doing a 1031 exchange where they're going to be reinvesting all of the net proceeds, 540,000 is going back in. They're replacing the debt with more debt, 660, and they're purchasing the property. You can see over on the end, there's no mortgage boot and there's no cash boot. So this is a full tax deferral exchange. Yes,
So what if there is no debt, the house is free and clear, then it's an investment property over 2 years, they do a 1031 exchange. And they said, I'm gonna use the whole capital to invest in this other one, and there will be no mortgage.
right, that's fine.
That's
Yep.
fine?
Mhm. Yeah, so if there's no debt, they don't need to replace the debt.
Okay,
It's all clear, but all the net proceeds need to be reinvested. Any amount of cash or debt that's not replaced is subject to capital gains taxes. So say they sold their property for $1 million and they buy something else for $1.2 million, but they're gonna keep 200,000 and get a bigger debt. The net proceeds that they keep are gonna be subject to capital gains taxes, even if they've added debt and purchased a greater
I
property.
see.
So all the net proceeds need to be reinvested. And then if there's debt, that debt needs to be replaced with either new debt or with cash. So just the amount minus closing costs and commissions is what needs to be reinvested for full tax deferral. So in this instance, they're gonna be selling their property for 900,000 and they're gonna be buying something for 700,000. So there was debt, same situation, 60,000 closing costs, 540. They're only gonna reinvest from the net proceeds, $440,000, so there's $100,000 of cash boot. And then they're not gonna replace all the debt, so then there's $40,000 of mortgage boot. And at the end of the day, they're gonna have $140,000 that is subject to capital gains taxes, which again is at 4 layers of 25% depreciation recapture, 14.4% possibly in California, 15 to 20% state, 15 to 20% federal, and 3.8% net investment income. So if people need to have some cash at the end of the day, what lots of investors will do is they will do a full reinvestment and then they will refinance the property and pull some cash out later, because that is not a taxable event. So if they don't want to pay those taxes, if they don't want to pay possibly 37% on that 140,000, it would make more sense for them to reinvest everything and then pull money out of the property after they've owned it for a while. And we're doing this again. They are going to reinvest all the net equity, but they're not going to be replacing all of the debt. So they're going to have 40,000 worth of boot, again, subject to capital gains taxes. If it's a property in California, that's going to usually be about 35 to 37%. That's going to be going to the government. So the 40,000 would be taxed at about 35 to 37% when you put all 4 of those tiers together. So the $40,000 that they didn't reinvest, sorry, I'm going the wrong way. The $40,000 that they didn't reinvest, that they didn't replace debt, that amount would be subject to capital gains taxes. So that 40,000 would have 25% depreciation recapture, 15 to 20% federal, up to 14.4 state, and 3.8% net investment income tax. When you put all those amounts together, it usually averages about 35 to 37%. Yeah, on that. So that's why the 1031 exchange is so important. Okay, steps to take prior to the exchange. You want to have your clients talk with their tax advisor. I've had multiple times where clients have come to me wanting to do a 1031 exchange, and after I talked to them for a while, they don't need to do an exchange. They didn't have any gains, or they inherited the property from mom 2 years ago. There's no gains. They got a step up in basis when they inherited the property. It hasn't appreciated more than like $8,000, and they don't need to reinvest closing costs and commissions, so there's no need to do a 1031 exchange. Say it's a property where there's losses that your accountant can actually put towards it. They may not need to do an exchange. So it's always very important that they consult their tax advisor, because if you don't need to do an exchange, there's no reason to pay me and to put yourself in the box of 45-day replacement property and 180 days to close if they don't need to do the exchange. So the first thing they want to do is make sure that they need to do an exchange. Once we've determined that they do need to do an exchange, contact the qualified intermediary. I would be happy to help. We're going to confirm who the taxpayer is, because again, it's a tax code for the taxpayer. So we want to make sure we have the correct exchange entity. And then we want to update, if we need to, the vesting on title to make sure that it's correct when it goes forward. So this is a typical exchange. So the taxpayer is going to sell the property. The buyer is going to send the money to escrow. When escrow closes, escrow is going to forward the funds to the qualified intermediary, where we're going to hold your funds in a segregated account with a large national bank. So the reason for that is to do a 1031 exchange, your clients are not able to have actual or constructive receipt of the funds. So the exchange agreement needs to be done prior to close of escrow, because if escrow wires the funds anywhere aside from a third party that is a qualified person, then the exchange will be blown. I've had people call me the day after, hey, I closed on my property yesterday. I want to do a 1031 exchange. I'm sorry, you're too late. Can we do it at the last minute? Yes. I've had people on day of closing say, oh my God, I want to do an exchange and I forgot to set everything up. We call escrow and we stop everything. Do not go forward until we get the exchange agreement done. And we'll put a rush on it. We can get it done usually within a couple hours, and then they might be able to still close on the same day. As long as it happens prior to close of escrow, you're fine. So typical process, your client's going to put the property on the market. An offer is going to get accepted. Once the offer is accepted and your property goes under contract, two things I suggest. First, call the qualified intermediary so we can get everything set up right away. Then we don't have to worry about it. Second, this is when you aggressively start looking for replacement properties with your client, because when escrow closes is when the time clock starts. The time clock is 45-day identification period. That flies by. And then 180 days to close. So if your client is worried about not being able to find a replacement property, two things. They can have a DST as a backup, or you might want to put something in the closing indicating that they're going to have an option to extend that closing to give them a little more time. Because again, once close of escrow occurs, that 45-day identification and 180 days, short of a natural disaster happening, those timelines do not change. So identification period, 45 days. There's different rules to that. First, it needs to be done in writing, and it needs to be signed by the client, and it needs to be returned to the qualified intermediary by midnight of the 45th day. Whatever is on that list cannot be changed. If everything falls out, then everything falls out, the exchange is blown, and they will be paying capital gains taxes. So again, it's important that whatever you've got on your list is going to be a viable option for your 1031 exchange. Now, the different rules. First off, the one that most people use is called the 3 property rule. Basically, you can identify up to 3 properties of any value and close on 1, 2, or all 3 of them. I need to go to the next slide, sorry. So like I said, the 3 property rule. So they can identify up to 3 properties of any value. This is the important part. 3 properties of any value and close on 1, 2, or all 3 of them. If your clients wish to identify more than 3 properties, they can do that, but they're going to put a cap on the amount that they can reinvest or that they can identify. So that's called the 200% rule. So if they sold their property for $1 million, the most they can identify with all the properties combined would be $2 million. So twice the amount that they sold the property for. And that's all the properties combined. So if it's more than 3, then it cannot be of any value. It will be the 200% rule. However, there's a 95% rule. This one is rarely used. So if they wish to identify more than 3 properties and they want them to be of any value, they can do that, but they have to close on 95% of whatever they identify. So they can identify 100 properties, they need to close on 95 of those. So most people are not going to identify or close on that many, but basically 95 is a lot. So unless they're absolutely positive that they're going to close on everything that they've identified, it's either going to be the 3 property rule or the 200% rule. So again, the identification rules, it must be made in writing and signed by the client. Unambiguously describe the property. You can't just say, oh, this place on the corner of Colorado and Lake is really cute. Has to be done unambiguously, address, suite number, etc. Unambiguously, if it's land, then the APN number. Must be hand delivered, mailed, telecopied, or otherwise sent. So email does work. But again, we have to have it back by midnight of the 45th day. Yes.
Can this happen, let's say, selling a house in Tampa, Tampa, Florida, I'm exchanging it to Arizona. And when that happens, could that applies the same rules?
Yes.
So it doesn't matter what state.
So for the 1031 exchange, you can do that. Any state in the United States is allowable, except for, I believe, Puerto Rico is not. But all the other states are. And you can only exchange within the United States to another place in the United States. If you own property outside of the United States, you can do a 1031 exchange, but you can't 1031 into the United States. You have to stay foreign. So it's either domestic or foreign, can apply, but it can't go in and out. And again, midnight of the 45th day, whatever is on that list, they're stuck with. Now, say they want to do a 1031 exchange, we get everything started, we're holding their funds on day 30, they're like, I don't want to do this anymore. So there's a rule called the G6 restriction. So that's fine, we'll cancel it, but the qualified intermediary needs to hold their funds until day 46. It's not our rule, it's in the tax code, just so they know. And if they identify the properties and they're day 100 and they're like, I'm not going to buy any of these, I don't want them. Okay, that's fine, we'll cancel the exchange. We have to hold their funds until day 181. So it's a G6 restriction. We have it on all of our information packets that we send out to new clients. So we make them aware of it. Just good for you to know too, that there is that G6 restriction. If they decide during 45-day identification, we have to hold till day 46. If they decide after that, then we have to hold till day 181. So replacement identification. So this is the form that we're going to send your clients if they're going to be doing the 1031 exchange. This is their identification form. We've got the rules there. We've got the area for them to unambiguously identify the property and sign it and return it back to us so that we make sure that we've got everything in order. Now, I've had some people say to me, well, yeah, I mean, you know, but after 45 days, if there's a property that I can budget, right? You guys can budget the dates, right? No, we don't do that. I've heard of some qualified intermediaries that do that, but we don't do that. And there's multiple reasons. First off, we would lose our license. So we wouldn't be able to do this anymore. We'd lose all credibility. Second, the client can get in trouble and will have to then pay capital gains taxes, have to pay a penalty, and possibly have jail time. So it's not only for our protection of our reputation, it's to protect your clients. So I do know some qualified intermediaries out there that do that. We do not do that. And if your clients want to do that, I would highly caution against that. Okay, so say your client owns multiple properties and they want to buy one, consolidation. So can they do that? Absolutely. They can sell 3 properties and purchase 1 property. However, one thing we need to keep in mind is that close of escrow date for that first one starts the 45-day time clock. So they're going to be selling multiple properties and they want to go into 1 property. They can do that, but you might want to put some close of escrow extensions on the first one or possibly the first 2 to make sure that you have plenty of time to identify and close for all the properties to sell. And can we go the other way? Yes, you can go the other way. You can sell 1 property and buy 3. I've got 3 kids. I want each one to have their own place. Perfect. You're going to sell it. Close of escrow is when your 45 days starts. So you're going to have 45 days to identify those 3 replacement properties and 180 days to close on all 3 of them. So that's allowable either way. So 1031 reverse exchange. Are these allowable? So what a reverse exchange is, say your client's out and they see this warehouse that is perfect. They need it, right? For their new business, or the old one's falling apart or whatever. They find something, they really want it. So they want to purchase it, but they have to sell their property. And this purchase is not going to wait for them to sell. So what we do is we do something that's called a parking arrangement, where we're going to park that property in an LLC, and we're going to hold title to the property for a specific amount of time. The only thing is with this is lenders are not great about doing that. So the large national banks that they're used to working with are most likely not going to give them a loan. There are reverse exchange lenders out there. I've got a list of some on my computer. So if your clients are wanting to do that, I do have some options, some places they can call. But technically speaking, that might be a part that's difficult for them if they're wanting to do a reverse exchange. So what's going to happen is they're going to purchase the replacement property. We're gonna, the minute they find the property, call us so we can get everything ready. We need 3 weeks to get it set up for a reverse exchange. And the reason for that is we have to create an LLC, and the LLC is going to step in the contract. So your client puts the offer in, they get the property they want, they call us, we set up an exchange accommodation title holder, an LLC, that's going to step into the contract, and that EAT is going to hold title to the property for up to 180 days. So if they're going to do a reverse, there's a couple things they need to keep in mind. First off, lenders might be a little difficult. Second, they need to make sure that their property is going to sell and close within 180 days. So if they're in an area, they're selling something in an area that has a lot of inventory and things are not moving, a reverse exchange might not be a good idea for them, because if it doesn't sell, they're going to have both properties, because at the end of 180 days, we're giving it back. We don't want it. We're just holding it for a specific time. But it's also really great if they find that property, or if they're worried about finding a replacement. They're like, I'm worried about that 45 days because I'm very specific on what I want. What if I can't find the right property? So there's a couple reasons to do it. First, they find like their dream place, or second, they're very picky or very worried about finding the correct replacement. So they're going to do the reverse exchange. Also, a reverse exchange is more expensive. They're $7,000 to $9,000 for the reverse exchange. Again, because we're going to create the LLC and we're going to be the title holder on the property for up to 180 days. A regular forward exchange, we charge $1,250. That covers the sale of one property and the purchase of up to 3. If they wish to purchase more than that, we charge an extra $200 per. So if they're doing the reverse exchange, sometimes just telling people that it's going to cost $9,000 makes them go, oh, I don't want to do that. $7,000 to $9,000 for a reverse. 7 to 9. So $7,000 to $9,000, depending on the circumstances. If they're coming with all cash, we can do it for a lesser price. If there's going to be a lender involved and we have to do other things, sometimes it's going to cost a little bit more, depending on how much work we need to do on our end. So we hold it usually in Citibank, in a large national bank, Citibank, and it's in a segregated account. We're also backed by Stewart Systems, which is a title company, is one of their roles. So we are just as diligent when we receive the funds as a title company or an escrow company would be. We have been around again for 25 years, and we've performed well over 200,000 exchanges on behalf of our clients. And then Stewart will provide an extra layer of protection for the funds while we're holding them. And they're a larger company. So not all your qualified intermediaries are going to have that extra layer. The amount of time that we put into building our reputation as one of the leading national qualified intermediaries. So the funds are secure and have always gone where they've needed to go with us.
And the fund can the 1031 exchange company move the fund away?
Can we move the funds? What do you
Yeah,
mean?
like this fund away. Close the company.
There have been qualified intermediaries who have taken money.
They take money and move to other country.
Yep,
They can do that.
they're not supposed to. But it has happened, yes. Yeah, it has happened where someone's come in, purchased a thing. They wait till the money, because I mean, we hold billions of dollars on behalf of our clients on any given day. So, because I mean, we're doing like somewhere between 300 to 400 exchanges a month. So we're holding all those funds in accounts, and as you know, everybody, there's 180 days possible that we could be holding those up to. So, yeah, it's really important that you're using a well-established, trustworthy, qualified intermediary. There have been times where qualified intermediaries took the money and put it into investments, and the investments have not gone well, and then the money was not there on the other end, or they've actually absconded with funds. Yeah.
Is this interest bearing?
Yes, some of it is, yes.
To purchase a rental order, and then we're doing the reverse exchange. So, and then I list their home and the proceeds, does it go to the accommodator or we keep them, because they're already, put in the cash for the purchase?
Right, so they're gonna put the offer in, of course, they're gonna put the offer in on the property, the offer is gonna get accepted. And then you're gonna call us, we're gonna set up the exchange, we're gonna hold title to that property for a specific amount of time. We're gonna hold title to the new property until you sell their property, and when that property sells, then the funds just go back to your client. That's when they get the money back, so. When they find their property, they have 45 days to identify what they're gonna sell, because sometimes people have multiple properties. So they're gonna have 45 days to identify what they wanna sell and 180 days to close on that. And then when their property sells, like you were saying, you listed their property, it sells, the funds are gonna come from the buyer to us, and then we're gonna give them back to the taxpayer. So during the time that we're holding title to the property, your client, in essence, we're leasing it back to them for, but there's no lease funds involved, but they're gonna have full management of the property during the time that we're holding title to it. So they can put in renters or put leases out or fix up the property, any of those types of things. They're gonna have full control of the property. We're just gonna be holding title to it for up to 180 days.
So during the period that's the LLC holding the title, if it's just a rental property, all the money the rental income will go to the LLC first. And then when the exchange is complete, then it go back to the,
It'll go to the client.
or monthly it will go back to the.
The funds will go to the client. Yeah, we're not gonna hold funds for the rental. We're just holding title to the property. Your client's gonna have full control over everything else. They can put in the renter, the money is gonna go to them. We're just gonna be holding title to it for a specific amount of time. The reason for that is they're not able to hold title to both properties at the same time. They can't own it at the same time while they're doing their exchange. So that's why we need to park title on that property for up to 180 days. And that creates like a safe harbor for that property. And then once they close on the sale, then those funds from the sale will go back to the client.
Because right now there are so many ATM. If I do the exchange, but for my current residents cannot do exchange, but my ADU is a rental. So how the IRS trip, how much money is for the primary, how much money is for the ADU? Would that be
That would be depending on how your tax accountant or how you've been reporting that. So if you've been reporting 25% of your property as rental and the 75% as your primary, you can do the split treatment and you can 1031 exchange that 25% and then use 121 for the 250 to 500,000 for the primary and purchase that way. So if they're gonna sell the property and 25% of it was reported as rental, and they want to do a 1031 exchange, that 25% needs to go towards another investment property. It can't go towards their primary for a 1031. 1031s are for investment property to investment property. So the amount that was investment can be done for a 1031, and then the other amount would be for primary purposes. It depends on, I'm just throwing out a number. It depends on what percentage of the property they were using for investment and what percentage of the property they were using as primary. So like earlier, I had a fourplex up there where they were renting out 3 of the places and they were living in one. So 75% would be an amount that they were doing. So it depends on how they were reporting on their taxes, what amount of it was investment and what amount of it was primary. So can a 1031 be set up at the last minute? Yes, it can. I don't recommend it. But we can do it on the same day, just as long as it hasn't closed, we're okay. If they find out on that last day that they want to do that, call escrow and stop closing until we get that thing signed and back to us. As long as we have it signed prior to close of escrow, they're able to do it. The day after is too late. So again, like it says, stop the closing, promptly contact a qualified intermediary. Once the 1031 exchange documents arrive, have the seller and buyer sign the appropriate forms, and then it's all good to go. So what we need to do the exchange, so when you open escrow, your client's gonna call me, or you're gonna call me with the escrow officer's contact information. I'm gonna contact the escrow officer. I'm gonna request preliminary title, the purchase contract, and any amendments. I'm gonna review everything and make sure nothing looks out of sorts, like, hold on, I've got this name on the title and this name is on the purchase contract and this name is on the amendments, like, who's the taxpayer? Let's figure that out. As long as that's all easy, those are the documents we need. I'm then gonna send that information to our headquarters. Headquarters is gonna put together the exchange agreement, and then they're gonna send it out to your client for review and signature. Once that's signed, they are good for their exchange. So yeah, those are the items I need. I need escrow officer's contact, and then escrow is gonna send me title, purchase contract, and any amendments, and if there's escrow instructions, those as well. I just make sure everything looks like we've identified the correct exchange entity, because again, it's for the taxpayer. I usually get it directly from escrow. Realtors do lots of times say, hey, we just opened, here's the purchase contract. I'm still gonna reach out to escrow and make sure that I've got the preliminary title. And there might be amendments that maybe the realtor forgot to send over, or maybe there's something from the other side that, you haven't gotten that needs to be put in. Sometimes maybe you'll just have your client signatures and you won't have the other side signatures. So I do check with escrow to make sure I've got all the documents in order. And when escrow closes, we send the wiring instructions to escrow, and then they send them to us, where we're gonna hold the funds in a segregated account on behalf of your client. And when they find their replacement property, if we need to, we'll send out earnest money deposit. And then when they're ready to close, then we forward those funds to the closing escrow on the other side. This is just a little bit about us. Experience, again, we've been around for 25 years. Expertise. Our founder, Javier, has been with us, and he'll still get on the phone if we've got something difficult or, hard to figure out, because crazy things come up all the time and there's a lot of nuances in 1031 exchanges. We have a lot of very seasoned professionals in our main office. So this expertise is important. And then as far as security, again, we hold them in a large national bank in a segregated account. And then we've got that extra layer of protection with Stewart Systems, who basically ensure well beyond what the regular errors and omissions and insurance covers for the regular banks and for the regular qualified intermediaries. So here's my social media. And here's my contact information. I left some brochures over there that talk about 1031 exchanges. And I also have my business cards over there. I'd love it if I could get business cards from all of you. And if any of you want a copy of this presentation, I can email that to you by the end of the week.
Go back.
Yeah, I can go back. Oh, I went forward, sorry.
Thank you. So thank you again for your
Thank you.
and informative presentation, and feel